you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall and here with me today is Stuart Mitchell, manager of the SWMC European Fund. Hello Stuart.
Morning.
So we're here today to talk about 3 European stocks. What's the first one you have for us today?
I was very keen to talk a little bit about Orange, which is the old France Télécom, the French former monopolistic telecom provider. And we're fascinated by the industry because it would seem now there's been an acknowledgement by policymakers that the industry isn't profitable enough to be able to support the development of new technology, whether it's rolling out 4G or high-speed broadband to every home. And so there's been the encouragement for consolidation within the industry, which should lessen competition, enable cost cutting, and allow these companies to become a little bit more profitable in the future. And there's all sorts of technological change as well. There's a fibre to the home, which we're all aware of, Infinity, of course, in the UK. And a similar technology is now being spread right across the continent. And that means now that the large incumbent providers like France Télécom are able to offer fast broadband services, but at a very competitive price. It's just a matter of getting the fibre to the cabinet, the curb, and then it's copper for the last 200 yards. So our hope is that France Télécom revenues will stabilise, even begin to pick up. The share price at the moment still very much discount falling sales into the future with continued very aggressive, vigorous competition. But we think it's more than likely that revenues will begin to start to recover perhaps as early as next year. And if we see that, then these share prices should be another 50% higher.
We've seen a lot of telecoms news recently, the news that Sky's going to launch mobile,
Yes.
the news that Google might launch a wireless network. How much do these sort of new players to the market threaten the old monopolies?
It's a very, very good question. I think it's, there's all kind of different forms of competition. From what we've seen over the past few years, the most disruptive has been when you have a large fourth operator which has got a weak balance sheet and is desperately just trying to raise cash in order to cover costs. So that would mean offering all sorts of highly competitive, aggressive programs just to be able to bring in some customers to raise a little bit of cash to pay the bills. And we've seen that's been right across Europe, much more disruptive. It's more difficult when you've got a large, highly profitable organisation, whether they'll be quite as aggressive. And of course, operators like Sky are MVNOs, and so they're renting spectrum from the large operators. So they haven't got that same capacity bandwidth as it were the 3 major operators will have in a market. And again, Google, that kind of technology is still in the development phase, around connecting up together distant wireless networks. I'm sure it'll be some kind of threat in the future, but again, we're not quite as nervous about those, because they're still kind of small in the development phase, but we're much more anxious. It's about the disruptive fourth player that really causes trouble.
And what's the second stock today?
And so the second stock is Ocado, very controversial, but our view is, we've had this for many years now and has been a great investment for us, but we think looking across different industries in the world, the last area to be penetrated by internet is our groceries. And as we all know, we probably buy a quarter of our purchases nowadays in using the internet, and grocery it's still around 3 or 4%. So we think there's an opportunity for that to really grow very fast. And at the end of the day, Ocado had the skill to be able to do that very profitably.
They did come in, so they started out just sort of provider of Waitrose,
Yes.
and then when they added Morrison's to the book, and that was sort of beneficial for both stocks because Morrison's
Yes.
previously hadn't entered the internet shopping arena, and the stock went up, but then it's been troubled since then. So why has it fallen? Why has it been volatile?
Yes, it's not quite. It's had a very strong bounce since Christmas, so it's back up to £4, £4.20 or so. So it's not at its high, but it's not that far off. It's 10 or 15% off its high, and I think there were a number of people were anxious. I think the primary fear was, the woes that people like Tesco are going through, and many thought, well, that has to somehow affect Ocado. And fascinatingly is if you look at the like-for-like data, the guys at the very bottom, like Lidl have done, Aldi have done extremely well. The middle ground has been devastated, and you've seen the Ocado, and you've seen rather Tesco and Sainsbury and all that. But the top end, Waitrose and Ocado and others have done extremely well. So there's been this kind of interesting development of the market where the two extremes have been thriving, whereas the middle ground has been pulled apart. And I think the other thing is, and this is for me the most fascinating question. It's around how do Ocado package this know-how and then sell it to other international companies, or maybe even somebody in the UK. And so far we haven't had any announcements yet. And I think some people in the market were kind of hoping for a big deal, whether it was with a French retailer or a German retailer, and that hasn't happened yet.
But it's in the pipeline.
It's in the pipeline. I mean, they're very confident and they're speaking to many people, and that's really this thing which will bring the share from £4 now up to £10 to £15 if they're successful. And I think many have underestimated the value of that know-how. I mean, the technology is clearly off the shelf, but putting it all together and making it work is highly complex, and they've been doing it for longer than anybody else.
And what's the third and final stock?
And the third one is Glaxo, which again is kind of a controversial one, and there are many people who followed this thing for years and been incredibly disappointed by the kinds of returns they've generated. And we've just been intrigued recently how, a number of things which happened which would seem to us that the company are becoming a little bit more shareholder orientated. And of course you saw the large deal with Novartis with the asset swaps and which will create a vaccines business, and can create a consumer pharma businesses which are have scale now and can cost and become become more competitive, as it were, have more value as businesses. The other idea is there's the thinking around floating off separately the AIDS business and all the technology around there, and arguably that could be, as a floated off separate entity, worth much more than it could highlight the value of that business. But for us, the most crucial thing is all around the cost structure, because if you look at Glaxo's costs over the last 5 or 6 years, they've grown by £2 billion, £3 billion or so, whereas revenues have stayed flat. So there's all kinds of opportunity for them to cut costs and get some back to best practice again. And I think Whitty's under enormous pressure now to do that. There's been a change of chairman, and there have been many investors who are doing all the same calculations that we are, who have been very critical and challenging and questioning of how tightly he's been controlling his cost structure. So in our view, if some of these things can start to be addressed, then the share's got 20 or 30% or so to normalise with the rest of the industry.
Stuart, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.